Today, we present you a trading indicator you have probably never heard of, the Choppiness Index. Please stay tuned because we'll show you one trading strategy that shows the potential of the indicator, as shown by the curve you see on the screen. First, what is the Choppiness Index? The Choppiness Index is an indicator created by an Australian commodity trader, Bill Dreiss, to show when a market is choppy or trending. A choppy market is one that is ranging or in a consolidation. The indicator is assigned values from 0 to 100. High values signify choppy waters, indicating a market caught in a range or consolidation, while low values hint at a potential trend. The Choppiness Index can help identify trend strength, but not directly like the ADX indicator, perhaps the most used trend indicator. It also differs from other volatility indicators because it is designed to determine whether the market is choppy or not choppy, and not to measure the size of price swings as the others do. For example, the ATR directly measures price range, while Bollinger Bands indirectly shows the size of the consolidation. Another difference is that the Choppiness indicator does not show market direction. It only tells you whether the market is choppy or trending. How is the Choppiness Index calculated? The Choppiness Index measures market volatility by analyzing the range between the highest high and lowest low prices over a given period. Through a series of calculations involving the average true range, it normalizes the result into a value between 0 and 100. Higher values suggest choppy waters, while lower values hint at smoother sailing. If you want to get into details of the calculation, please look at the linked article below the video. Now, let's talk about the strategy. We backtested the Choppiness Index on SPY, the ETF tracking the S&P 500, and the results are pretty good. We combined the Choppiness Index and the Relative Strength Index. The Choppiness Index is used as a trend filter while we time entries with the RSI. Our strategy is simple yet effective. When the Choppiness Index dips below 50, signaling a range-bound market, and the 2-day RSI falls below 20, we go long. The idea is to avoid trending markets. We sell our position when the close ends higher than yesterday's close or after 5 trading days. The backtest reveals an average return of 0.64% per trade, with the strategy invested only 15% of the time, yielding nearly 8% annually. The performance equals a risk-adjusted return of 52%, and max drawdown is 23%. Let's change the trading rules and only buy when the Choppiness Index is above 50, while the other rules stay the same. As you can see, the results are more erratic, and the average per trade drops to 0.17%. Thus, it seems the Choppiness Index might offer value. In conclusion, why choose the Choppiness Index over other volatility indicators? Our strategy shows that the Choppiness Index works well as a trend filter. Unlike its counterparts, the Choppiness Index isn't concerned with the size of price swings or market direction. Instead, it focuses solely on identifying whether the market is choppy or trending, providing a clear signal amidst the noise of market volatility. If you like this video, please like and subscribe.